All right, how's everybody doing? Welcome to the Strategy Room. This is Saturday night, February 1st. Can't believe we're already through January already. I love getting through January. I think January is probably the hardest month of the year to get through just because of the winter time, and it's 31 days. It's a long month. But I always say, if you can get through January, February and March always seem to just fly by. Obviously, February's got the shortest number of days of months in the year with just 28. March has got 30. So I don't know. For some reason, February and March always seem to, fly by a lot quicker. And then we get, hopefully in a couple months here, we'll be into springtime and get through another winter time period. So, all right. I have got a ridiculous amount of stuff for everybody tonight. It has been it's been another amazing week, and which is great for me because this just makes my show that much better, and it just gives me a lot more information to hit you guys with here tonight. So just a number of the things that we're going to be going over tonight. So Scott Bessent is in as the Treasury Secretary. Mr. Chopra is out at the Consumer Financial Protection Bureau. That actually happened today. That actually happened earlier today. Doge now apparently has access to the Treasury system, Treasury accounts. We'll be talking about the Federal Reserve. Their interest rate decision earlier this week. A little bit more on debt, the debt ceiling. We're going to be talking about economic indicators. I'll go over episodes that I had last week. We're going to talk about the outage at Capital One and why that is such a big issue. We're talking about the first bank failure so far this year. It's a small bank, nothing major, but it was the first bank failure of the year. I got a ton of bank news and everything to go over with you guys. So just an onslaught of information. But I'll tell you what, we'll kick it off with this right here. So Senate confirms Scott Bessent as the Treasury Secretary. So the veteran investor will oversee Trump's economic agenda. So the Senate confirmed Scott Bessent as Treasury Secretary on Monday, putting the longtime investor at the center of President Trump's efforts to cut taxes, fight inflation, and impose stiff tariffs on imports. So what we know, the Senate approved Bessent's nomination in a 68-29 vote. The Treasury Department is the premier economic policy making agenda in the federal government. It implements tax policy, manages the nation's debt, leads financial regulators, controls sanctions, and conducts economic diplomacy. And Bessent is expected to oversee Trump's push to extend the tax cuts the Republicans enacted in 2017. Many are set to expire at year's end. Failing to extend the tax cuts would have devastating consequences for small businesses and many households. Bessent argued this at his confirmation hearing earlier this month. Bessent is part of a nascent second-term economic team made up of wealthy businessmen, Wall Street veterans, and hardline advocates of aggressive trade policies whose differing worldviews could lead to disagreements over how Trump implements his agenda. We shall see. But the big picture, Trump has moved to implement his economic agenda even before Bessent was confirmed. The president has said he would impose 25% on tariffs in Mexico as soon as Saturday, which, yes, indeed, he did. And yes, indeed, that has become a reality as of tonight. The tariffs could set off a continental trade war with the U.S. as leading trade partners. I don't think so. As a matter of fact, I would be willing to bet that Mexico and Canada. So what time is it right now? About 8:03. I give it till about tomorrow morning, about noon, before they're crying uncle and begging for mercy. Yeah. But I digress. I'll get more into that in a little while. Okay. All right. Other big news here for today. So Trump fires the head of the Consumer Financial Protection Bureau. This is not a shock. I think the only thing that was shocking is why did it take 10 days? I'm really surprised that this gentleman was not gone 10 days ago or maybe even a little before that. Many of his compatriots had resigned or stepped down from their posts, a couple of days before Trump took office. But he is a Biden holdover who basically previously threatened banks and that refused to give credit lines and loans to illegal aliens. Yes, he did do that. Pretty amazing. But I'm not going to dig into this whole article and go through all of Mr. Chopra's exploits. I'm just happy that he was gone. Mr. Chopra was pushing a very radical agenda over at the CFPB, and it was kind of wild watching him, the last couple months because, normally what happens when you have a changeover in presidential administrations is that normally people realize, like, okay, we lost the election. There's going to be a changeover here. We're not going to be able to get done all the things we wanted to get done. So we'll be professional. We'll do we'll kind of gather up what we can and then do a nice handoff. That has not happened this year. The CFPB went like gangbusters, trying to just jam through every little thing they could possibly get done. And it was to such a degree that one of the things that Trump did was basically write an executive order putting a freeze on basically all of the things that were put through in the last couple of months until they could be reviewed and basically determined if they were or were not necessary. So, but I, for one, very happy to see that this is gone. He needed to be gone. And hopefully we will get a better person over running the CFPB. So like I said, so Scott Bessent in as Treasury Secretary, Mr. Chopper out over at the Consumer Financial Protection Bureau. And then obviously, I'll come back to this in a minute. This was the whole AI DeepSeek thing that happened this week. We'll get back to that in just a second. But so I want to look at a couple articles here on the Fed and the Fed's rate decision this week. So the first thing was, and I'm going to take you through a couple articles here over the last few days, kind of guide us through here a little bit. So Fed Focus. So the Fed was set to basically pause rate this week with an uncertain path ahead. So why would it be uncertain? So let's look at a couple charts here. So majority of futures market expects 2 rate cuts or fewer in 2025. So we have, again, number of people looking at 5 rate cuts has dramatically diminished, dramatically gone down. 4 rate cuts, 3 rate cuts, 2 rate cuts. Right now, they're the betting odds, if you will, on Wall Street for what the percentage will be here. 1 cut, still very high. I mean, you're over 30% probability of 1 cut, about a 33% probability of 2 rate cuts. But we'll see. I mean, I think right now, though, we're probably not looking at it. Even if there is a rate cut, you're probably looking at nothing happening until at least June. That would be my guess. And then let's take a couple look at other things. So bond yields have risen since the Fed started cutting rates in September of 2024. So what I talked about last week, if anybody was tuning into last week's show, something that happened in the first time in history, the Fed decreased interest rates by 100 basis points and Treasury yields increased 100 basis points. First time that's ever happened. So basically that rise in Treasury yields completely negated all the cuts that the Fed made, and it basically left us in a position where nothing really happened. It was kind of like a stalemate. Then we got here, and we'll talk about this a little bit more in a few minutes as well. Key inflation measures have stopped falling. Not only have they stopped falling, they're now increasing. They're now going up. So, and then the 3 main indexes, if you will, that you look at are the PPI, the CPI, and the PCE. We're going to talk about the PCE here in a minute. The PCE is the Fed's preferred inflation index. It's the one that they put perhaps the most emphasis on of the 3. But you have to look at all 3 in context to kind of get the full picture of what's going on there. So, but like I said, not only has inflation basically stalled, it's now beginning to creep. It's now beginning to creep back up over, wait for it, the last 4 months since the Federal Reserve started decreasing interest rates. Okay, and then now, final chart here. Mortgage rates remain near 7%. So the 30-year fixed rate mortgage average in the U.S. still clinging to about 7% right now on the week. I think everybody's hopes were that the Federal Reserve was going to start cutting interest rates, and that means interest rates were going to come down. Haven't seen that. That has not been the case there. And I've talked about the reasons for that, why, the national debt plays such a big part in that whole thing. So why the Federal Reserve did not cut the interest rates? Well, like I said, we got mortgage rates here at 7%. We got inflation beginning to creep back up just a little bit. And, we've got bond yields going back up. So you get to this point where you're like, what is the point at the moment of the Fed cutting the interest rates? And there really isn't much reason for them to do that. So let's go on here. So bank stocks rise slightly after Fed holds interest rates steady. So U.S. bank stocks rose slightly after the Federal Reserve said it would keep the federal funds rate in a range of 4.25 to 4.5%. The Fed has lowered interest rates by 100 basis points since September 24th, when rates were at their highest point in decades. The KBW Nasdaq Bank Index closed up 0.03%, while the S&P 500 closed down 0.48%. And that was on Wednesday. So it's not for Friday. That was for Wednesday. And I don't think there's any chart. Yeah, well, and this is kind of interesting. This is not my favorite yield curve chart, but I think you can kind of get the gist that the yield curve, you're running about normal there. I prefer some of the other yield curve charts, which I think are much better, which has a better pattern showing the sloping or the steepening of the yield curve. Whereas here it's just, it's more of a straight line pattern. Okay. And so what do we got here? We've got the Fed holds rates as looming Trump tariffs threaten inflation fight. So U.S. President Donald Trump's brewing trade war could launch as soon as this weekend, potentially upending the Federal Reserve's battle against inflation. But the central bank appears constrained to fight the expected price effects of the looming wave of new tariffs. This panic over the tariffs, I think, is kind of funny. Let me just say something about the tariffs for a second. Why is it? I just pose the question to everybody. Why is it that every other country around the world is allowed to hit us with tariffs, but the minute we go to hit somebody else with tariffs, it's like the end of the world? It's like, oh my gosh, the U.S. is hitting somebody with tariffs. It's horrible. The economy's gonna blow up. Whatever. I mean, it's so over exaggerated as to be ridiculous. All that Trump is doing with the tariffs is basically it's for negotiation, and it is also just to level the playing field. We don't have free trade right now. I mean, I think free trade is one of the biggest misnomers. We don't have free trade. What we have is the U.S. trades with other people, and we get taken advantage of. And that's not free trade. Free trade is not the U.S. getting taken advantage of all the time, and everybody gets one over on us. So again, we'll have to take a look at that as it goes. But like I said, I just feel like the whole tariff debate is it's really overblown, and it's not going to be this giant disaster, this giant detriment that so many people think that it is. It's going to end up being. But anyway, I digress. But as expected, the Fed on January 29th, they held their benchmark rate steady. As annual inflation growth remains stubbornly above the Fed's 2% goal, and the domestic labor market has yet to show signs of significant weakening. The meeting, however, comes just days before a potential February 1st start date of increased tariffs on products from Mexico, Canada, and China as Trump pursues economic protectionism. Those tariffs are expected to increase prices on goods from those three countries, which account for more than 40% of goods imported into the U.S. and could be coupled with additional tariffs on goods from Europe, Russia, Brazil, India, and Colombia, causing prices of shoes, cars, television, beers, and dozens of other goods to soar for U.S. consumers. The increase would pressure inflation, potentially pushing price further growth away from monetary policymakers' goals. So the increase would pressure inflation. I want everybody to think about that for a second, because we're going to come back to that in a few minutes. I'm going to show you something why that is not true. I'm going to show you something in a few minutes, but I need you to kind of hang with me on this for a minute. So, okay. So let's continue on with some other things here. So again, Fed holds rates steady, takes less confident view on inflation. The decision again followed 3 straight cuts in September of 2024. The post-meeting statement offered a somewhat more optimistic view on the labor market, while dropping a key reference from the December statement that inflation has made progress toward the Fed's 2% inflation goal. Now, what I've been telling everybody for the last month is that, the Fed kept saying, oh, we're making progress to our 2% goal. They have made zero progress in the last 5 months toward this 2% goal. Everybody who's been looking at the economic indicators can see that the decrease in inflation stalled out between basically 2.5% to 3%. And the core inflation numbers have been accelerating back up just over 3%, 3.1, 3.2, 3.3%. So not only has the Fed not been making any progress getting toward the 2% goal, but inflation's been ticking up the other way the last 4 or 5 months since they started decreasing interest rates. This is actually why I didn't want them to start bringing interest rates down. So, um, and then another article here, Fed ends streak of rate cuts, entering wait and see phase. The Federal Reserve held the funds steady. The Fed is entering a wait and see mode of its battle against inflation after 3 rate cuts late last year. The Fed stopped cutting rates after inflation stopped falling and the labor market held steady, reducing the urgency of boosting the economy by lowering borrowing costs. The Fed's key interest rate influences borrowing costs on all kinds of loans, including mortgages and lines of credits, of course. Okay, so let's look at their statement. This is the actual FOMC statement that came out, and let's just read over this for a second. So recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2 percentage points over the longer run. The committee judges that the risks to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. And considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. Now, pause for a second here. That sentence is a key sentence. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. What that means is the Fed is going to continue with their tightening policy, and they're going to continue to reduce their balance sheet. That's what they've been doing for the last year or so, and they're going to continue on that path. The question is that ultimately really good for the economy? And the answer is, well, it depends. It depends on if you believe the economy is as strong as what they claim to be right now. Again, they're saying that the unemployment rate is stabilized at a low level in recent months and the labor market conditions remain solid. But do they really? Are they really? I don't think they are. I don't think they're anywhere near as strong. I think a lot of these numbers have been highly massaged. I'll put it that way, highly massaged. While inflation remains somewhat elevated, they weren't saying that a month or two ago. Okay, so in assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. Voting for the monetary policy action were Jeremy Powell and the other members. I believe, what is my paper here? It was a unanimous policy vote. The Fed will remain on hold and base future adjustments to target rate range based on further assessment of economic data, the evolving outlook, and balance of risks. Fed will continue reducing its holdings of Treasury securities, agency debt, and agency MBS. So there you have it. So that basically, like I said, so Fed decided to hold interest rates steady. Nothing really changed this month as was expected. Again, if you've been kind of watching my live stream here for the last 4 or 5 months, I've been telling people that I had highly expected the Fed was going to take a pause in January. And I believe if we are going to see a rate cut, it probably will not come until sometime in June. So now we get into the juicy stuff. This is the juicy bit. So if you all remember last week, Trump did a video conference at Davos, where one of the big things that he did was he said he He used the word demanded. He demanded that interest rates come down immediately. So here we go with that. Fed's Powell has had no contact with Trump after President said he'll demand rate drops. So Powell's comments came after Federal Reserve members announced they were keeping the benchmark interest rate steady. I'll demand that interest rates drop immediately, Trump said during a virtual appearance before the World Economic Forum in Davos, Switzerland last week. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, Powell said Wednesday. So Federal Reserve Chairman Jeremy Powell said Wednesday he has not spoken to President Donald Trump since the newly inaugurated president told business leaders he would demand central banks lower interest rates. Speaking after the Fed's decision to hold interest rates steady, Powell said he had no contact with the president since Trump's remarks last week. I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, Powell said Wednesday. The Federal Reserve is designed since its founding in 1930 to make interest rate decisions independent of pressure from elected officials. However, Trump in his first term as president was unusually vocal with his opinions on what the central bank should do. His remarks during the 2024 campaign and since his election victory have pointed to that continuing in his second stint in the White House. I'll demand the interest rates drop immediately, Trump said at Davos last week. Powell was originally nominated to be Fed chair by Trump, taking over the position in 2018. He is now in his second term in the position, which runs through May 15th of 2026. Powell has said he would not resign from his position if asked by Trump, and that he believes the president removing or demoting the Fed chair is not permitted under law. Wednesday's interest rate decision was the first since Trump returned to the White House. The Fed had cut its benchmark interest rate in 3 previous meetings by a cumulative total of 1 percentage point. Inflation readings were above the central bank's 2% target. Trump criticized Powell and the Fed later on Wednesday, saying in a Truth Social post that the central bank failed to stop the problem they created with inflation. Yeah, he's not wrong. So now that we have all that, let's have a little fun here for a second, shall we? Okay, so this is Zero Hedge on X. Let me see if I can boost this up for everybody for a second. So first they said, first post was, any minute now, Trump will learn that Powell ended cutting rates as soon as the vegetable, we all know who the vegetable is, was booted from the White House. The reaction will be glorious. And there it is. Because Jay Powell and the Fed failed to stop the problem they created with inflation, I will do it by unleashing American energy production, slashing regulation, rebalancing international trade, and reigniting American manufacturing. But I will do much more than stopping inflation. I will make our country financially and otherwise powerful again. The Fed has done a terrible job on bank regulation. Treasury is going to lead the effort to cut unnecessary regulation and will unleash lending for all American people and businesses. If the Fed had spent less time on DEI, gender ideology, green energy, and fake climate change, inflation would never have been a problem. Instead, we suffered from the worst inflation in the history of our country. You may not like the way he delivered the message, but he's not wrong. He's not wrong. So where does this leave us at the end of the day here? Well, we're left in a position where the Fed is standing pat because they basically have to. I know, Trump, demanded interest rates come down. Do I want interest rates to come down at the moment? I would say no. Because here's the other thing. We can't go back to 0% interest rates. And there's a number of reasons for that. First of all, the Federal Reserve basically, they morphed our economy, and most people just, they really don't understand how bad the Fed completely upended and turned our economy completely on its head for the better part of 15 years. And now they're trying to go back. And, we've seen the ramifications of the going back. And that has been, the increase in inflation, the all bailout all the time economy, the Fed's, ginormous balance sheet, the ballooning national debt. We've seen all the problems that have gone along, with the Fed and all the things that they have done. but that's a very long conversation and it's very complicated. And that's why, like, if anybody goes and if you really want to learn all about that, go and watch my series on the Lords of Easy Money. Because I walk through everything that the Fed has done over the last 15, 16 years. And I explain exactly why and what they did and how horrible of a job they did. But where do we go from here? It's a great question because, I don't think Trump is not going to relent, right? He's not going to back down on this. And I think Jeremy Powell will probably fight him to an extent. I'll say to an extent. But again, you understand why Trump wants the rates to come down. Trump wants the rates to come down to get things moving again, to get the economy moving again. And do I think you need to dramatically decrease rates to accomplish that? No, you could probably just lower the rates, get the rates back down to say 5%. And that would probably be enough to really energize and really get a lot of things rolling again. But here's the thing. I am more concerned with inflation than I am with higher interest rates. I would take we've all experienced the massive inflation over the last 4 or 5 years. I would take the higher interest rates every day of the week over higher inflation. Why is that? Well, because we've seen it. We've all felt that pain at the grocery store, at the gas pump, when buying anything that your every bill that you have in your house. Everything has gone up dramatically in the last 5 years. We've all experienced that, and you can't out earn that. If inflation goes back up to 7, 8, 9, 10%, you can't out earn that, and you're going to drown. The inflation will drown you. It will drown consumers in a very real way. It already has. We haven't dug out from that situation. We're just kind of treading water at the moment, if you will. So I would take the higher interest rates over potentially reigniting inflation. And speaking of reigniting inflation, let's take a look at something else. Oh, wait for it. Here it is. The PCE report shows Fed's favorite inflation measure accelerated in December. Wait for it. It accelerated in December. So inflation, as measured by personal consumption expenditures, rose 2.6% over the year in December, up from 2.4% in November, and in line with forecasts. I always love that. That's my favorite thing, in line with forecasts. As the Federal Reserve's goal of a 2% annual rate fades into the distance, Fed officials have grown more reluctant to cut the central bank's key interest rate, which would push down borrowing costs on all kinds of loans. Core inflation, which excludes volatile prices for food and energy, stayed flat in December, providing a less pessimistic outlook for the trajectory of inflation in the coming months. I wouldn't bet on that. I'm just looking down here to say, core inflation, which excludes volatile food and energy prices, did not accelerate, but rose 2.8% over the year, the same as in November. On a monthly basis, it rose 0.2% compared to 0.1% in November. Fed officials and economists pay close attention to core prices because food and gas prices fluctuate from month to month for reasons that have little to do with broader inflation trends. Overall, economists said the inflation data didn't provide any reason for the Fed to break out of its holding pattern on interest rates. The central bank cut rates, we already got that last year. But here's the thing. Here's the important thing. Again, it's the inflation trends. The inflation trends are going back up. That's the big reason, the main reason, I believe, why the Fed cannot cut rates right this minute, because the inflation is ticking back up. Wait for it, because they decided to start cutting rates back in September. If they would have just held steady, we'd probably be in a better place right now. Residential mortgage rates, if they had just held steady and done nothing, residential mortgage rates probably would be hovering around 6% or something right now. So it would be a little bit better. Speaking of that, pending home sales dropped sharply in December as mortgage rates surge back over 7%. So pending home sales dropped sharply in December as mortgage rates climbed. The average rate on the 30-year fixed rate mortgage went from a low of 6.68% on December 6th to a high of 7.14% on December 19th. Pending sales fell in all regions, with the West and Northeast seeing the biggest monthly drops at decreases of 8.1 and 10.3%, respectively. Signing contracts on existing homes dropped a sharp 5.5% in December from the previous month and fell 5% from the prior year, according to the National Association of Realtors. The drop followed 4 straight months of gains, and the index was at its lowest level since August. These so-called pending sales are an indicator of future closings and are the most current indicator of activity in the market. Buyers out shopping in December were facing a big jump in mortgage interest rates, which may have dampened demand. I'm looking for something else here. Contract activity fell more sharply in the higher priced regions of the Northeast and the West, where elevated mortgage rates have appreciably cut affordability, said Lawrence Young, chief economist for the National Association of Realtors. Job gains tend to have greater impact in more affordable regions. It is unclear if heavier than usual winter precipitation impacted the timing of purchases. Prices are still stubbornly high and rising across the nation. Annual gains accelerated in late fall and early winter, according to the latest reading from the S&P Case-Shiller National Home Price Index. So home buying demand does not appear to be bouncing back at all in January. Mortgage applications to purchase a home last week were 7% lower than they were the same week a year ago, according to the Mortgage Bankers Association. Homes are also selling at the slowest rate in 5 years, according to a new report from Redfin. One of the 4 weeks ended January 26th. The typical home listing that went under contract sat on the market for 54 days before the seller accepted an offer, the longest span since March of 2020 and a week longer than this time last year. The weakness comes as the supply of homes for sale is finally rising significantly. The number of newly listed homes jumped just over 37% in January compared with December, according to Realtor.com. The shift in seller activity could mark a turning point in the high mortgage rate induced standoff between buyers and sellers, said Daniel Hale, chief economist at Realtor.com. The uptick is likely due to some residual benefit from fall's lower mortgage rates, which could fade and probably will fade. So again, not a lot of great news here at the moment. You got, again, the PCE numbers are up. The mortgage rates back up over 7%. Pending home sales have dropped. And I even saw a thing that pending home sales were at their lowest level since 1995, which is crazy. Okay, now let's take a look at GDP for a minute. How is GDP doing? This is more numbers we got this week. So GDP grew at a 2.3% pace in the fourth quarter, less than expected. GDP accelerated at a 2.3% annual pace in the fourth quarter. The Commerce Department said economists surveyed by Dow Jones had been expecting an increase of 2.5% after growth of 3.1% in the third quarter. For the full year, GDP accelerated 2.8% compared with 2.9% in 2023. Consumer spending rose at a robust 4.2% pace and, as usual, amounted to about 2/3 of all activity. In other economic news, the Labor Department reported initial unemployment claims totaling 207,000 for the week ending January 25th, a sharp decline of 16,000 from the prior period and well below the forecast of 228,000. So the U.S. economy growth slowed a bit more than expected in the final 3 months of 2024. Gross domestic product, a measure of all goods and services produced across the sprawling U.S. economy during the period, showed that the economy accelerated at a 2.3% annualized inflation-adjusted pace in the fourth quarter. Economists had expected a little bit better. So, again, I don't know. I don't know. I don't believe a lot of these GDP numbers. I think it will be very telling to see what happens here over the next quarter, 2 quarters, as we begin, now that we have, a different administration in there. I think that all of a sudden, some of the numbers that you were getting are going to be very different. I think GDP numbers, the labor market numbers, I think, are going to change as we are going to begin to be given the real numbers and real evidence. But we shall see. Another article here on this, just, U.S. economy grew slower in the fourth quarter, but still solid. Yep. Importantly, for the economy's trajectory, consumer spending accelerated, suggesting shoppers still had plenty of momentum heading into the new presidential administration. A decrease in investment in business inventories dragged down growth. Does the consumer really have, I've said this so many times, and I keep saying this. I don't like looking at consumer spending because the reality is with inflation, people have had to spend more money just to buy the same stuff or the same amount of stuff. They're not getting more. They're getting less but they're having to spend more money to get less. And so is that really is that really a great, view of where the consumer is right now? When I want to look at the consumer, I look at the fact that we're sitting on all-time credit card debt, that the buy now, pay later has exploded. If anybody, I'll talk about it in a minute, but if anybody saw the report that I did covering the CFPB, just did a report that came out last week on buy now, pay later and how people are using it. And it was a very telling report. I'll talk about more about that episode I did in a few minutes, but you definitely should go check that out. So, but basically their savings is exhausted. So savings is exhausted. Inflation is ticking back up. Inflation is taking a chunk out of everybody. But credit card debt at an all-time high, and then you have this explosion of buy now, pay later. When you combine all those things together, I don't think the consumer is looking super hot at the moment. That's just my take on it, based on all those different economic indicators and different economic factors. Okay, let's talk about the debt ceiling for a minute. Okay. So the U.S. has hit the debt ceiling. How long does Congress have to fix it? So our good friend, our lovely friend of the channel, Janet Yellen, love Grandma Janet. I hope that I think she's on a porch. I vision her in my head. She's on a porch somewhere where knitting some yarn, finally hanging out with the grandkids. She finally cashed all those Wall Street checks for $7 million for the speaking fees that she got 4 years ago. And, now she's sitting back, and it's just time for Grandma Janet to enjoy that retirement. So, God bless her, all the most to her. But let's see the situation she left us with, shall we? The U.S. government hit its congressionally set debt limit on Tuesday. And this article is a week old. Tuesday, setting up a potential showdown over limited or extending the debt ceiling. The Treasury Department is continuing to pay its bills without borrowing by using extraordinary measures, but can't do that forever. The X date on which the U.S. will no longer be able to pay its bills could fall in the spring or summer, depending on tax receipts and disaster relief spending. If Congress fails to extend the debt ceiling, the U.S. could face a financial crisis and economic recession. Yes, absolutely. The government exceeded its borrowing limit on Donald Trump's second day in office. Oh, that's fantastic. It was so nice of Grandma Janet to leave us in this situation, leaving the new government with an uncertain deadline for the X date when the U.S. can no longer pay its bills. On Tuesday, the total debt owed by the U.S. government overtopped the $36.1 trillion it's allowed to legally borrow, setting the stage for a scramble by Congress and the White House to fix it before the U.S. fails to pay its bills. It set off a financial crisis. On Wednesday, the Treasury Department began undertaking extraordinary measures, essentially shuffling money around that will buy the government some time before the U.S. can no longer pay its bills, according to a letter to Congress by outgoing Treasury Secretary Janet Yellen. She did not estimate how much time exactly the measures would buy. Of course she didn't, because she knows it's leaving us with no time. If the X date comes and goes, the government would enter uncharted territory, possibly defaulting on the national debt, leaving Social Security benefits unpaid, and facing other potentially severe financial and economic consequences. The debt ceiling timeline depends on unknown factors, including how much revenue the IRS collects this tax season and how much the government spends responding to the recent wildfires in California and other disasters, the Bipartisan Policy Center, a centrist think tank, said in a commentary. The debt ceiling has become a political flashpoint in recent years, as some lawmakers have threatened to allow the debt ceiling to lapse in order to extract concessions from the opposing party. Yes, I think that is the next point that I wanted to get to, was basically that this is going to be used as a political football. Both parties in certain respects are going to try to leverage this to their advantage. Now, if you recall, the last 4 years, it would be the Republicans who are always be threatening, oh, we'll shut down the government if we don't come to a deal, if you guys don't do something. And then the press would hem and haw and would blame it on Republicans. And then Republicans would lose their spine because they would say, oh my goodness, if we actually close the government down, the press is going to beat us silly and we'll all lose re-election. And now the shoe will be on the other foot. Now the shoe will be on the Democrats' side, and the Democrats will threaten to shut down if they don't get what they want from Republicans. And once again, the press will beat Republicans over the head, and we'll see what happens with this. This is all going to come to a head, I think, basically in March, because you got the government spending bill, which is basically got the can kicked down the road. Republicans are supposed to be working on a couple of different, one giant bill or a couple of individual bills right now. But the debt ceiling is going to loom large in those negotiations, and it's going to play a big role in all of that. Let's take a look here. So here's my favorite thing, the U.S. debt clock. So we can see here, and I love looking at this thing. This thing is fascinating. So you see up here in the upper right-hand corner, and I know this is a little hard to see on the screen, but you got Doge, the Doge clock here. Now the Doge clock is saying that they have potentially saved us about $46 billion so far, which I kind of have a hard time believing that that's reality. I think I saw some things online today, basically saying that they probably saved us about $1 billion so far, just with eliminating certain contracts and other things that they're working on. But there's so many fascinating things on here. Like you see, like U.S. debt to GDP ratio in 1960, 53%. In 1980, 34%. In 2000, 59%. Now it's 122%. So for anybody who doesn't know in economic parlance, once a country goes over 120% debt to GDP, you're broke. Okay, just so everybody understands that. You go over 120%, you're broke. So we're at 122% right now. That's really bad. That's really horrific. And we have to find a way to get that number back down. I mean, even in 2000, at 59%, again, not a fantastic number, but not horrible. Not like the country's finances are in terrible straits. No, it's at 122%. I mean, it's just insane how out of control it is. Some might go back to 1960 and say, well, in 1960, our debt to GDP was 53%. But you have to remember, that was still coming kind of out of the heels of World War II and the Korean War. So we had incurred this massive debt during World War II, and it took us basically a decade to basically work our way out of that hole. The thing back then was that you had politicians that wanted to work our way out of that hole and put us back into a better financial situation. Today, we don't have that. We have a bunch of politicians that basically could care less. And if you were wondering, so the Republicans this weekend in Congress are doing some kind of retreat or something, and they leaked out what they were working on in terms of their idea of a budget cut. And I said this before, and I knew this was coming. Their idea of a budget cut was basically cutting like $300 billion over the next 10 years. Basically, saying like, well, we'll cut about $30 billion a year. I might not be the world's greatest math expert, but when you're running a $2 trillion deficit, I don't think $34 billion is going to do anything. That's like, you could cut $34 billion by simply walking down the hall and saying, oh, hey, we're not going to put those signs up, and you're going to have to skip a lunch for the next couple of days. There we go. I just cut $34 billion for the government. Like, I mean, it's a joke. It's a bad joke. These guys need to get real serious, real fast. And this is what I said. I said this a couple months ago. People were going to find out, like all the people that voted for all these Republicans, you're going to find out real quick that the Republicans, just like the Democrats, both sides of the aisle, they have no desire to cut the debt. None. They have no desire, no appetite, because it goes like this. You start walking down the aisle and you're like, okay, we're going to cut this, and we're going to cut this, and we're going to cut this, and we're going to cut that. And then all of a sudden, all the politicians go start having a panic attack and going, wait a minute. I was all cool. I was all for cutting, but I didn't know you meant you were going to cut my stuff. I don't want to cut my stuff. I would have cut all their stuff. I don't want to cut any of mine. And then they all go down the aisle going, oh my gosh, yeah, I'm not cutting mine. If they're not cutting, I'm not cutting. I don't want to cut. I'm not doing this. I need to get reelected. I need to bring the goodies. I got to get the goodies back home. If I can't bring the goodies home, I'm not going to get reelected. That's how the politicians think, and that's their modus operandi. That's what they're going to do. And anyway, I could spend hours just talking about this debt clock here. There's so many fascinating things here. The derivatives contracts. You got $722 trillion in derivatives contracts. Yeah, we could spend a day talking about that one, baby. Woo, that's a big one. And then you've got all the unfunded liabilities over here. Look at this. U.S. unfunded liabilities, $226 trillion in unfunded liabilities. Let me say that again. Look at this. Think about that for a minute. Our national debt is $36 trillion. Our unfunded liabilities are $226 trillion. You can't even wrap your mind around some of this stuff. These numbers are so mind-boggling. But anyway, like I said, if you ever get a chance to kind of look at this, and there's also, there's money supply down here too. There's just a ton. Yeah, I mean, there's a ton of stuff on here. You could spend, like I said, I could spend all day going through all these different things here. And then they have other stuff here at the top. They have state debt clocks, world debt clocks. You have the time machine. You could go back, look at past stuff. You can go forward, look at future stuff. But anyway, so I digress. I probably spent a little bit more time on that than I wanted to. So, okay, let's talk about, I'm going to talk about this for a couple minutes, and then I'm going to get into some other stuff here. So the Capital One outage spans days and hits thousands. Now, this article is a couple weeks old. This is from January 21st. And I meant to talk about this last week, but I kind of ran out of time. So I want to talk about it now. So Capital One outage spans days and hits thousands. So third-party vendor FIS blamed a local power loss and hardware failure for the issue, which Bank of Oklahoma said affected more than 24 financial institutions. So for anybody who doesn't know, FIS is what you call, they are a core service provider. They are the main operating system of the bank. And you have a couple of big core system providers around the U.S. You have Jack Henry, you have Fiserv, and you have FIS. They're probably the big three, the big three main ones. The three of those companies together probably control somewhere in the neighborhood of like 70 to 80% of the whole banking market. So FIS is one of the big core system providers in the U.S. So I'm wanted to explain this because it's important to understand this. This isn't just some random third-party vendor. This is the bank's key vendor. This is their key system. It's the key vendor. This isn't somebody that they just, they hired to perform one little ancillary service for them. It is the main service, the thing that runs the entire bank. So, okay. A local power loss and hardware failure at third-party vendor FIS appears to be at the root of a several-day service interruption that saw thousands of Capital One customers unable to access their direct deposit paychecks, see their account balances, or log in online. Jacksonville, Florida-based FIS in a statement Monday confirmed the system outage, which began Wednesday, adding that it was not the result of any cyber incident and that affected clients. And affected clients are back to processing business as usual. Tulsa-based Bank of Oklahoma counted itself among more than 24 banks affected by the outage, CBS News reported. Our digital platforms are back online and balances should be displayed correctly. The bank wrote Friday in a statement on its website, we will refund fees incorrectly assessed on accounts impacted by the outage. The banks affected, Capital One, took the brunt of online complaints. What's in your wallet? One user posted on X, formerly Twitter, in a play on the company's slogan, nothing if you bank with Capital One. Some customers were decidedly less cheeky. My money hasn't come through since Wednesday, another user wrote. I have to pay my blank mortgage. I have to pay for gasoline. I have to feed my children. I called and was hung up on after inputting all my information. Something is very wrong. Capital One posted Sunday that account functionality for all customers is now restored. We sincerely apologize for how frustrating this experience has been. The bank added, we are committed to making it right. We encourage customers to check their accounts online and contact us for any support. Nearly 4,000 Capital One customers had reported issues to the website Down Detector between 9 a.m. Thursday and 9 a.m. Friday. That number fluctuated Friday, but rose to about 4,000 again by the afternoon. Let's see here. And then it kind of talks about Capital One here, some city customers, city spokesperson. So why am I kind of showing this? Why am I looking at this? Well, here's why. So I have been reporting on, I've done a couple of episodes over the last few months about how regulators are really taking a look at third-party vendor relationships for banks. And this really started last year. You had the failure of a fintech company called Synapse Financial Technologies. And Synapse Financial Technologies failed, and Synapse had been doing business, basically working with a couple hundred banks across the country, maybe even 400 banks across the country or so. There were a couple of main banks. Evolve Bank and Trust was one of the main banks that got kind of tangled up in this whole thing from the Synapse failure. But what ultimately happened was you had customers, about $85 million was missing. Still haven't been able to find or locate that money. And it's the big question, like, well, who's going to pay for it? And then suddenly anybody who was operating through a fintech platform like a Chime or a Yodel or Yoda, whatever that app is called, if you were using a fintech app, you basically found out for the first time the hard way that these apps are not banks. They do not have FDIC insurance. They're not FDIC insured. So if you had $10,000 sitting in that account, guess how much you're going to get back? Zero. You're going to get back zero. You're going to get back nothing. And so people were basically shocked to find this out, because they thought that like Chime and these other fintech companies were basically had FDIC protection, the FDIC insurance. They do not. And so then it became this whole question about, well, okay, well, who's going to pay for all the, who's going to pay for this? Where's the 85 million? Who's going to pay for it? And it turned into a huge debacle, which basically then has led a lot of the regulators to basically say, you know what, we need to kind of refocus our efforts on third-party vendor management, third-party vendor relationships. How are banks managing these relationships? What are banks doing in the event that something bad happens, i.e., FIS goes down and Capital One has an outage and 4,000 of their customers have no way of accessing their bank accounts or their money or anything like that. So the point here is that this is not going to help that situation. This is going to exacerbate that situation further. Because, now regulators are going to look at it and say, oh my gosh, Synapse went down and that was just like a third party fintech that banks were working with. But now we got, core service providers going down. This does not look good. So I unfortunately think that this incident, while it was, again, it seemed to be the result of a local power failure, hardware failure, not like a cybersecurity issue. But I think that there will be ramifications for this, and we'll continue to see how this unfolds and how this plays out. But it was, this was a big story for about a week or so. And so, like I said, I meant to cover it last week, but I wanted to cover it, so now I have. So, okay, so let's take a break for just a second. I'll do this free advertisement for Diet Coke. There you go. Do I get paid for that? Probably not. Okay, so I want to do our economic indicators, or not. I want to talk about what economic indicators are coming up for this week. I also wanted to give you guys a little bit of bank news, and I also wanted to talk about the 5 episodes that I did this last week, just so everybody could go take a look if they want to take a look at those when they get a chance. So on Monday, I had episode 307 came out, and this was a look at CFPB report on flood insurance that just came out. And this was kind of an interesting report, just because it talks about the more recent tragedies and stuff that, obviously the California wildfires, more emphasis on the big floods that hit like Tennessee and North Carolina. And basically the ramifications of, they do get into a little bit of, climate change and stuff like that. But basically how these disasters are ultimately going to affect flood insurance, the flood maps, the flood insurance programs, all that kind of stuff. I will put a caveat here. I did get a sense that it was kind of interesting as I was reading the report initially, going through it. As I got toward the end, I kind of got a sense that I'm basically like, is this report a CYA? Like, is this just a CYA on the part of the government to basically just to say, oh, hey, we've looked at this and we understand this, so like just to kind of set the stage for different things they may or may not want to do coming down the pike here very shortly. So that was just kind of a gut reaction that I had after being done reading the report. But I think people should go check it out. Definitely if you're in banking or if you're a lender and you have to run flood searches all the time, I mean, it's definitely worth looking at this just to get an idea of kind of some of the things that are going on there with potential changes with flood maps and flood insurance programs and things like that could be coming down the pike. Then I did episode 308, which was I covered a report called What's Going On in Banking 2025. This is an annual report that gets put out by a great company, Cornerstone Advisors out in Arizona. Cornerstone Advisors is a little bit of a hybrid company. How would you describe them? They are basically, they're a consultant for banks, but they're also a fintech company. And they also do phenomenal research. Ron Shelvin, who is their chief research guy over there, he does a absolutely phenomenal job. If anybody wants to go follow him, he's up on LinkedIn, always posting great stuff on LinkedIn. I highly recommend you go check it out and follow him. But Ron's a great guy, and he does an amazing job over there. So, but they worked on this, what's going on in banking 2025. And every year they put this report out at the beginning of the year and just kind of take a look at like, okay, well, how did the last year end? And then what do we got looking forward? What's coming on this year? And basically a lot of the discussion, just some discussion on AI, a lot of discussion on open banking, kind of looking at the pros and the cons of open banking, bringing up some of the things that I have mentioned about open banking, some of the potential, severe problems or consequences that could come along with that. Along with a number of other topics. But like I said, if you want to go check that episode out, go check it out. I have links to the report and everything in there. Then on Wednesday, I did episode 309, which was I covered ICBA's advocacy and action for the fourth quarter of 2025. So this is a quarterly report that gets put out by the ICBA, just covering all like the kind of the key regulatory issues going on in the banking industry. And I always love it because it basically comes out as like a 2-page PDF document. And it just does a quick, rundown on all the key topics, all the key things going on in banking, and love to cover that. So I always look for when that comes out, and I always do an episode kind of covering that every quarter. So if you want to just get a quick, if you want a 10, 15-minute video, just giving you a quick rundown on all the key regulatory issues in the banking industry right now, that's your episode right there. And then on Thursday, I did episode 310. I did the GAO report. So GAO, GAO, that is the Government Accountability Office. So the GAO report on the Treasury's actions around the 2023 bank failures. So GAO covered the Federal Home Loan Bank and their actions during the 2023 bank failures. So now we're getting the Treasury's actions and, what the Treasury did. And the GAO basically comes in and basically clears the Treasury, said, oh yeah, you know what, it was fine. Janet Yellen, she worked in conjunction with the regulators. She went to President Biden and got his approval on everything. And, they shored up all the uninsured. They covered all the uninsured deposits at these banks, at Silicon Valley and Signature Bank. And, so basically, clearing them, saying, oh, all the actions were great and this and everything. But I took issue with a couple of the things in there. And I took issue because they made no mention of the fact that, Janet Yellen got up there to testify last year in 2024, and basically was asked the question by one of the senators from Oklahoma. He basically said, well, wait a minute, if I had one of these banks in my district had failed, and they had some uninsured deposits, would you have covered them? And Janet Yellen said point blank, no, I wouldn't. I wouldn't have covered them. I wouldn't have done that. So the picking of winners and losers, and look, some people may not like it, but it just is the truth. Silicon Valley Bank was a huge bank in Palo Alto, California. A lot of wealthy Democrats had their deposits in that bank. Then you had Signature Bank in New York. A lot of wealthy Democrats on Wall Street had their deposits in those banks. I would imagine probably a lot of big donors probably calling, screaming and yelling, putting the pressure on, hey man, you better cover my deposits. I better not lose my deposits. This is not going to be good for you. So I imagine there was a lot of politicking, a lot of things going on with that, but just it's this idea of the government kind of picking winners and losers, picking like, well, we'll cover the deposits of this bank, but we wouldn't cover the deposits of that bank. So, but again, I don't want to get too much on my soapbox there. Like I said, it was just one thing that kind of stuck in my craw as I was going through this report, but a good report. I think it's got a great flow chart. People should look at it if they want to kind of understand a little bit more about like how kind of what the Treasury does in those kind of situations and how they take actions and how the decision making is done. Some pretty cool things. And then also at the end of that episode, I point people to some other related reports. Like I said, the gal did the report on the Federal Home Loan Bank. The Chicago Federal Reserve did a key report on some things that they thought were related to the bank failures of 2023. So I just kind of point out some of these other reports that I thought were related to that and should be kind of looked at in conjunction with that report. So, and then finally on Friday, I did episode 311, which was kind of a very interesting thing. It was called "What Happens When Your Customers Can't Sign Documents." I saw this blog post from PCBB where basically they talked about, Gen Z, for the most part, has not been taught cursive handwriting. So if you are unable to sign your signature, what do you do? Now, from a legal perspective, an X can be considered a valid signature. And why is that? Well, if you have somebody who's like partially incapacitated, but as long as they can make an X, that could be deemed illegal for legal purposes as a signature. Now, does an X really work for, can you have customers, everybody just writing an X in there? No, that's not going to work. You need a valid signature. It's part of an identification process at a bank. If somebody comes in to cash a check or they want to do a withdrawal or something from your bank account, one of the things they look at is they try to look at your signature and say, okay, does this signature match what we have on file? And, does this make sense? So it's very interesting. So again, it was an interesting thing to look at there. When you have a whole generation of customers that basically aren't really going to be able to, sign, they're not can't sign a deposit slip, can't sign loan documents, so it does, like I said, it's something that we take for granted. You just kind of take for granted that you're going to sit down with somebody and that they're just going to be able to sign away and, no issues, whatever. But that's not the case. And it will, again, I think for a little while, for maybe next, 5-10 year period of time, it may prove interesting to see how some of this stuff plays out with that. But the blog post does offer a couple of suggestions, kind of like digital signature on, online signature, kind of like a DocuSign kind of thing, that kind of stuff. So, but like I said, we'll continue to see how that plays out. But I just thought it was interesting. I just thought it was really interesting because it's just not, something that you would think of every day, right? Okay, and this week coming up, I've got a number of really interesting episodes coming up this week. On this coming Friday, I'm going to be releasing an episode. My good friend Alan Berkeley, if anybody remembers, a couple of the I was doing this series for a little while last year called Conversations with Alan Berkeley, where I would just have Alan come on and kind of just talk about what was happening in the banking industry, just to get like another banker's thoughts or takes on some of the things that was going on there. But what we did was him and I actually decided to do like a read along. You had a bank in Kansas that failed last year, and the CEO of that bank got all caught up in this big crypto fraud, this big crypto scam, which was basically what's called a pig butchering crypto scam. And I actually cover that in the crypto series that I do, if anybody wants to go check that out. But the story is it's a crazy story. It's a crazy story of what happened. So I found an article in Bank Director that basically covers the whole story. And what I wanted to do was, so Alan and I basically we read through the article, we comment on a whole number of things. We cover a whole bunch of topics, internal controls, separation of powers, the idea of a dominant CEO. Could the board have done anything any differently? How does the bank failure affect the local community in a small town in Kansas like that? How long it takes to build up trust and rapport with people, and how quickly it can be destroyed. And what are the implications, the ramifications of that? So I thought it's a longer episode. It's probably about a 45-minute episode, but I think people will find the conversation. I think they'll find the story really interesting. I think they'll find the conversation really good. So keep an eye out for that, as well as, like I said, some of the other episodes I have coming out this week. So okay, so let's take a look at a couple interesting things that happened this week. So the U.S. SEC, they rescinded an accounting regulation, which was called Staff Accounting Bulletin 121, that required banks to classify Bitcoin and other cryptocurrencies as liabilities on their balance sheets. Issued in 2022, SAB 121 provided interpretive guidance on the accounting treatment and disclosure of cryptocurrency assets held by financial institutions and banks on behalf of consumers. In October of 2023, the Government Accountability Office determined that the SEC's SAB 121 is subject to congressional review. The U.S. House of Representatives passed a bipartisan bill to overturn the rule in 2024, which was vetoed by then President Joe Biden, but it has now been rescinded. So the SEC has rescinded that. So that, again, makes it a little bit interesting with cryptocurrency, right? Like, will banks begin to dip their toe more in cryptocurrency? That obviously rescinding that rule helps a lot, because if you don't have to classify it as a liability, that could definitely makes it a lot easier, right? Yeah, we talked about interest rates by the Federal Reserve. We talked about how Scott Bessent got sworn in, and now I want to get into, okay, what economic indicators do we have coming out for this week? So on Monday, February 3rd, we got manufacturing PMI. We got construction spending. We have FOMC member Bostic is going to speak, and we have the Atlanta Fed GDP Now numbers are going to come out. On Tuesday, February 4th, we have factory orders. We have the JOLTS job openings, and then we have API weekly crude stock. On Wednesday, February 5th, we get the ADP non-farm employment change. We get trade balance. We get the services PMI, and we get the Atlanta Fed GDP Now. We get another update from them. Thursday, February 6th, we get the continuous jobless claims, initial jobless claims, and then Fed Waller is going to speak at 2:30. And then finally, on Friday, February 7th, we get average hourly earnings. We get the non-farm payrolls. We get the unemployment rate. We get the Michigan consumer sentiment, and we get consumer credit. So ton of labor department information this week, with ADP non-farm payrolls, initial jobless claims, continuous jobless claims, the JOLTS, a lot of stuff there. A lot of FOMC members are going to be speaking this week, and then obviously the Atlanta Fed, the GDP Now numbers. So a lot of good stuff, a lot of great, interesting things coming up this week. So, okay, let's get back to some of the news here. Let's look at some things. So Okay. This was interesting. I think I talked about this a little bit last week. So this is related to BOI and the Corporate Transparency Act. So we are still sitting in limbo on this. Small businesses will not yet be required to report ownership information to the Treasury Department after the Supreme Court on Thursday left in place an injunction that stopped enforcement of the Corporate Transparency Act, which mandates that small businesses report ownership and other pertinent information as part of what the agency has said is a bid to stem money laundering. This is all BOI, beneficial ownership information, which I have been covering a lot for the last couple of months. Just to let everybody know. So basically, the Supreme Court made a decision, but they're basically going to be having, there's going to be hearings in March in which basically they're going to have like some arguments back and forth. So basically, until then, the injunction remains in place, and we're gonna see what happens. We're gonna see how this plays out. I believe, and I totally believe that BOI, this whole Corporate Transparency Act, and the beneficial ownership information, and this whole database and everything that the FinCEN wanted to set up, I believe it's totally unconstitutional. When they got sued by the National Small Business Association, the National Small Business Association claimed that it was unconstitutional, and they won hands down. They won hands down in court, no question about it. And that's why we ended up with this nationwide injunction. So I truly believe that if this has its day in court, this thing is going to get shot down, because it is absolutely an invasion of privacy. For one, it probably violates 5 or 6 other amendments in the Constitution. And so we'll see what happens. We'll see how this thing plays out. I do think that at some point this thing will get up to the Supreme Court, but we'll see what happens here. So, okay. Next up, I have a couple of kind of commercial updates, kind of commercial real estate updates, if you will. So this was an article, this is more locally based in my area, but it's more, Philadelphia office market braces for put your money where your mouth is in 2025. So after years of uncertainty in Philadelphia's office market, a bit more clarity may finally be coming. So leases totaling 2.7 million square feet of space in Philadelphia's central business district are set to expire in 2025. If you didn't know, that's a lot. That's a lot. By far the most space in an upcoming year until at least 2030, according to brokerage firm JLL. The outside leased expirations this year are forcing companies to make long-term decisions that will shape the office market for years to come. So in addition to typical office leases, short-term deals signed during the throes of the COVID-19 pandemic are also expiring. Now that tenants have largely figured out their new usage, they're more likely to make long-term commitments. We're going to get a lot of data points as a result of the fact that we're seeing this lease rollover cycle. Newmark's Philadelphia market leader, Lauren Gilchrist, said, we're going to get more data about how occupancy is changing. As experts and observers keep a close eye on what tenants do, the trends could tilt the market and determine the next step for building owners, suggesting or struggling to pay off loans. The rollovers come as the office vacancy rate in the central business district hovers around 20%. That's a lot. That's a lot. And companies have tended to downsize as much as 40% or more. So yeah, so we're going to see. So there's a lot of office lease space coming on the market this year. And it's going to put there's already a huge office vacancy. There's a glut of vacancy on the market right now of 20%. So it's going to be a very interesting year in the Philadelphia market for office market. We'll see, a lot to be determined there. So, and then CRE loan modifications create a looming maturity wall. So I've talked about this too a little bit. So the maturity wall comes from this. There was just a report that I covered a few weeks ago called Extend and Pretend. So banks across the country have been doing what's called extend and pretend. Basically, they've been extending loans, pretending and hoping, more so hoping, that interest rates would come down, and it would make it easier for them to do the refinancing. Because quite frankly, they've got a lot of borrowers right now that at 7%, the numbers aren't working, and they're going to have a hard time refinancing a lot of these properties, is basically what it amounts to. So now we're basically faced with the reality that, rates are not going to come back down. They're not going to come back down anytime soon. They're definitely not going to come back down to the level that people were hoping for. People were hoping that the Fed was going to be real aggressive and that rates would come back down to maybe somewhere in the 4.5% to 5% range. But like I said, now that's definitely not happening. It's not going to happen. So now banks have this, because of all the extensions pushing these loans out. Banks are now faced with this maturity wall that's basically going to hit now, and it's not going to peak until 2027. So basically, this reads: a staggering number of commercial real estate loans have been issued short-term extensions since the COVID-19 pandemic. What comes after those loans reach their new maturity dates could provide a telling look at how the U.S. office market is faring. This practice of extend and pretend, as it's sometimes referred to in the industry, is being closely monitored as CRE lenders use extensions and modifications to delay writing off loan losses. An analysis by the Federal Reserve Bank of New York in October found that as of the fourth quarter of 2023, a looming maturity wall in which a disproportionate number of loans are set to mature in the near term represented 27% of bank capital, up 11 percentage points from the fourth quarter of 2020. So that report there by the New York Reserve Bank, that's what I covered in the one episode that I did called Extend and Pretend. So in the short term, the resulting credit misallocation might slow down the capital reallocation needed to sustain the transition of real estate markets to the post-pandemic equilibrium. In other words, banks are going to have a big problem on their hand because they got a mismatch between, capital going in and capital going out, basically. For example, supporting the conversion of office space into residential units and recreational spaces in large urban areas. The Federal Reserve Bank report noted in the medium term, the delayed recognition of losses exposes banks and all other holders of commercial real estate debt to sudden large losses, which can be exacerbated by fire sale dynamics and bankruptcy court congestion. So yes, so basically there's this huge maturity wall coming, and this is going to have a major impact on commercial real estate this year, without a doubt. Okay. And then here was an interesting one. So SBA loan programs targeted for substantial reforms under the Trump administration. So the Small Business Administration lending programs, including its flagship 7A and disaster relief loans, will be targeted for changes as part of a wider effort to modernize the agency under President Donald Trump's nominee to lead the organization. Business executive and former Senator Kelly Loeffler detailed some of her plans for the agency during her nomination hearing before the Senate Small Business Committee on Wednesday. Loeffler, who is no stranger to the SBA, said tackling rising delinquencies and early defaults within the 7A program is a top priority. These are the types of things, red flags, that should have been put up sooner, Loeffler said, adding that the 7A program historically functioned with zero subsidy from the taxpayer, but is in danger of needing additional support. We're in a position right now, as this year starts, that may not happen, she said. Loeffler cited as another priority rooting out fraud in lending programs. She said the agency would have a zero tolerance policy toward waste, adding she would be continuing COVID collections to ensure the greatest return to the taxpayer, although she did not specify that what those collections could mean. Lawler also said she would conduct a review of existing SBA programs to see what's working and what's not working, a review that includes the agency's financials as well as its ability to pass a financial audit, something the SBA has not been able to do in the last few years. A review would include how the agency handles customer service and business owner requests. How long is a case open, and when they have a question, how long do they have to wait on the phone for someone to answer it? Loeffler repeatedly criticized the Biden administration's handling of the agency, including its disaster loan program, which ran out of funding in 2024, delaying loans to small businesses until Congress provided additional funding more several months later. Loeffler said a number of changes made to the SBA's programs during the Biden administration could be rolled back. Yes, I absolutely agree with that. I think that the Biden administration badly mismanaged the SBA. Now, what is important for people to understand what's important to understand for a lot of people is that basically the SBA has always been one of the few government agencies that actually made money. It actually made money. It was actually like a self-sufficient agency, and they brought in a ton of money through fees that they charged on the SBA loans, and that basically paid for their whole the whole SBA department, if you will. And that was a good thing. It was one of kind of like the nice shining lights in the government, if you will. But a lot of that has not been so. I think the SBA has really been mismanaged in the last few years. I think they've done a lot of just stupid things, quite frankly. They completely mismanaged just the whole SBA with the EIDL loans. And I do believe, I will say this now, Mrs. Loeffler, former Senator Loeffler, she said that she really wants to come down on collections, right? She wants to make sure that, we're collecting all the money for the taxpayer, which that's all good and fine. However, I have said before, I have changed my stance on SBA EIDL loans. I do believe that they should be forgiven. If they still, now that doesn't say that they shouldn't still pursue fraud. If there are blatant instances of fraud, and it's kind of funny. I'm doing this because I'm actually doing an episode on this. I found a story where 7 individuals have been charged with what is perhaps the largest COVID tax fraud scheme in the U.S. to date. So I kind of cover that in an episode this week. But and in that article, it basically says that there are thousands of currently open SBA fraud cases that have been brought. So there's a lot there. There's definitely a lot there to be looked at, but I truly believe that the EIDL loans should be forgiven at this point. I think they should be forgiven, and that they should basically continue to focus on their fraud collection efforts. Go back, review loans. If they find fraud, definitely go and try to put those perpetrators in jail if necessary. Try to reclaim as much money as they can. But that being said, I do think the anybody who's got EIDL loans, those loans I think should be forgiven. I think the Trump administration should really highly take that into consideration, because I think that would help a lot of small business owners out there that are struggling under that debt right now. So, all right, I'll leave it at that. Okay. Let's go through a couple. I just got a couple minutes left here. Let's go through a couple other things here. Some other headlines, if you will. So fewer Americans face foreclosure in 2024. So that's a good thing. It's good. Foreclosure filings fell 10% in 2024 compared to the prior year, a sign that the housing market is stabilizing. Foreclosure filings affected 0.23% of U.S. properties, higher than the 0.11% in 2021. Foreclosures are still lower than they were in the pre-pandemic era. So again, that's a good thing that, foreclosures are holding steady. So hopefully that trend will continue there. This is interesting. MicroStrategy bought another $1 billion in Bitcoin last week. So I know I haven't really covered MicroStrategy. I haven't really talked about them. But it's an interesting company. And this gentleman here, was it Michael Slate? Is it Michael Slater? I'm trying to look for his name. I think it is Michael Slater, but we'll get to that in a second here. So, but basically, here's what I wanted to look at. So, MicroStrategy bought another 1.1 billion of Bitcoin, its largest purchase in more than a month, and its 11th consecutive week of buying. The company added 11,000 Bitcoin to its holdings, bringing its total to 461,000 Bitcoin, worth roughly 47 billion at current prices. It financed this latest acquisition through the issuance and sale of shares. So MicroStrategy's Bitcoin buying playbook has included selling shares or leveraging debt to fund purchases. Last year, it announced plans to raise 42 billion over 3 years using these methods to build its Bitcoin book. It expanded that goal by 2 billion earlier this year. On Tuesday, MicroStrategy voters will cast their ballots to decide whether the company should increase authorized shares of Class A common stock to 10.3 billion from 330 million, and its authorized preferred stock to 1 billion from 5 million. If that vote goes through, it will add to MicroStrategy's ability to use share sales to buy more Bitcoin. As of January 21st, MicroStrategy has roughly 5.42 billion left in equity available to issue under its current capital plan. MicroStrategy's Bitcoin acquisition strategy has not come without criticism. Some investors question the risks tied to its approach based on debt and equity issuance, but it has inspired other listed companies such as Bitcoin miner Marathon Digital to follow its Bitcoin treasury blueprint. The company's stock fell as much as 7% in early trading, but recovered a little to trade 3% lower in recent trading. Over the past year, MicroStrategy shares have gained more than 690%. It's a very interesting thing. Basically, what happened is this gentleman, again, I think it's Michael Slayer. He came in, and basically MicroStrategy did something completely different. And then he came in and he basically said, okay, we're going to change the strategy, and we're just going to turn this into a company that basically just buys Bitcoin. And we're going to build this massive Bitcoin portfolio, thinking that we're just going to invest the money and Bitcoin is just going to go up and up and up and up. Kind of sounds like a little bit of a Ponzi scheme, doesn't it? It's just kind of what it sounds like. And that's what people online have accused this company of being. That basically this dude here is just perpetrating a giant, what could potentially be a massive pump and dump scheme. But we'll see. I mean, again, I'm not giving anybody any financial advice. I'm not making any any oh, hey, go out and buy this or don't buy it or whatever. I'm not doing that. I am just covering a story. So this is just a story that I found very interesting, this MicroStrategy, just because I've seen a lot of people online kind of blast this company for what they're doing right now and how they're doing it. And I just think that in of itself is interesting. And it will be curious to see, they got this big vote coming up. And that is really, just so you understand, you're really diluting shareholders by doing that. I mean, you're going to issue Class A common stock to you're going to increase it to 10.3 billion from 330 million. That is just a massive increase. So it'll be interesting again, just to see kind of what happens at that vote. If what the shareholders really think. That'll be very interesting to see. So, okay. A third of middle-class U.S. households plan to buy vehicles this year. That's good. So 1/3 of middle-income households intend to buy a car in 2025, according to a survey from financial services provider Santander. Many households have delayed purchasing a vehicle in the past year due to high costs. Price increases for new cars have leveled off, but the used car market will likely remain tight, auto software firm Cox Automotive said. Yes, the cost of cars is become absolutely staggering. I cannot believe. If you're just looking for a 4-door sedan, and again, these are new car prices, but if you're just looking for a 4-door sedan, it might cost you $44,000. If you are looking for an SUV or a truck or something like that, you could be looking anywhere from like $70 to $90 or $100,000. I mean, it's just the price of new car vehicles has just gotten just completely out of control. And you got a lot of people that I think the average age of the car now is like 12 years old. So, people for the last 3-4 years have really been holding on to their cars for a lot longer, really trying to milk everything they can out of it. But sooner or later, you have to bite the bullet and you got to go out and buy a new car. You can't just roll forever. So, but well, like I said, I think that's good news for auto buyers, or I'm sorry, for auto sellers. It's good news for auto sellers, but we'll see how that plays out. Most student loan borrowers are overwhelmed as repayment plans keep changing. So, most federal student loan borrowers are overwhelmed and confused as back and forth lawsuits have created an ever changing student loan landscape. Currently, 7 out of 10 borrowers are overwhelmed when navigating repayment plan options, and even more are unsure what plan is right for them. The new Trump administration has threatened to unwind many prior repayments and forgiveness plans. Any changes to monthly payments could add to borrower confusion. Yes, and here's the thing. I do feel bad. I do feel very bad for a lot of student borrowers out there right now. However, that being said, once upon a time, I was a student loan borrower and I borrowed a lot of money to pay for a lot of education, and I paid for it myself out of pocket. So, do I have sympathy for hey, if you have a bunch of student loan debt out there right now, no, I don't, because nobody forced you to go to college. Like, nobody put a gun to your head and said you got to go to college and you have to sign these notes. Like, no, you did that. You did that. You went to college. Hopefully, you graduated, but you went and got the degree that you wanted, or you chose, and so now you have to live with the consequences of that. I'm sorry, but that's just how I feel about it. Like, you have to be, you have to be responsible for your debts and your obligations. That's how our economy works. And I think it stinks. I think it's terrible that Joe Biden basically made promises that he knows he could not keep. I mean, the Supreme Court literally shot down a bunch of his schemes for trying to give, trying to forgive, $1.4 trillion in student loan debt, which is absurd because again, you're not forgiving any debt. You're just, yeah, okay, that person's debt may be forgiven, but now you're just putting it on all the back of the taxpayers. So now basically I have to now pay for everyone's college debt. No. Your debt, your obligation. There you go. But I do feel bad that basically, Biden was out there basically trying to buy votes, by saying, oh, hey, I'll forgive all your student loan debt. I'll forgive all this. I'll take it out. No problem. And he did run around, forgiving chunks here and, a couple billion here, a couple billion there. He picked basically the low hanging fruit, knowing that he was never really going to fully deliver on this or could deliver on this. He knew at some point he was going to get the door slammed in his face, and he was not going to be able to, forgive $1.4 trillion in student loan debt. He knew that wasn't going to happen, but he was doing it just for election purposes, just to get reelected. Which again I feel is sad because you're playing on people's emotions. And you're making promises to them, which he knew he wasn't going to be able to deliver on, and that's wrong. And that's wrong. So again, I do have some empathy there for student loan borrowers, but at the end of the day, like, hey, look, hey, your debt, your obligation, you got to pay it. So, okay, I had a bunch of other things I wanted to get into, but I'm kind of running, so I'm going to end with this. So basically, state regulator closes Chicago-based Pulaski Savings Bank. So the Illinois Department of Financial and Professional Regulation closed Chicago-based Pulaski Savings Bank on January 17th and appointed the FDIC as receiver. The state regulator, in cooperation with the FDIC, took possession and control of Pulaski Savings Bank due to its unsafe and unsound condition and impaired capital position, according to a news release. To protect depositors, the FDIC entered into a purchase and assumption agreement with Des Plaines, Illinois-based Millennium Bank, pursuant to which the latter agreed to assume all deposits of Pulaski Savings Bank at the time of closing for a 4.61% premium. Millennium Bank will also purchase about $45 million of the failed bank's assets, and the FDIC will retain the remaining assets for later disposition. As of September 30th, 2024, Pulaski Savings Bank reported total assets of $49.5 million and total deposits of $42.7 million, according to a separate news release by the FDIC. So yeah, small, tiny little savings bank out there in Illinois, but it got the dubious distinction of being the first bank to fail in 2025. So like I said, just wanted to report on it and just wanted to report on that and cover it. And let's see here. One last thing here. Do I have anything on X here that I wanted to point out? Yeah, job data, existing home sales. Yeah, they got control of the treasury accounts. Doge just gained access to U.S. Treasury system. This is going to be insane. The previous Treasury Secretary, Janet Yellen, was bribed by Wall Street, making over $7 million in speaking fees. I mentioned that a little earlier. But yeah, you get ready. You get ready. You strap in and hold on tight, because I think the things that you are going to find out of what Grandma Janet Yellen there was doing are going to be wild. And okay, and this I love this here. So, and I talked about this at the beginning of the live stream tonight. So, Trump signs 25% tariffs on Canada, Mexico, and 10% on China. So the legacy media has done a great job convincing the public that tariffs are inflationary. This couldn't be further from the truth, because they slow growth. Tariffs are and always have been deflationary. The price of specific items may rise, but the net effect is 100% deflationary. And then he shows a video here. So inflation is going to slow things down. This is what it's going. Tariffs are going to slow down the inflation. They're not going to add to it. So I think, again, just, pointing that out. And again, it just helps to make the argument of what I was trying to state earlier, that we don't need to be afraid of the tariffs, and the tariffs are not going to add, the tariff conversation is just like the nonsense that Janet Yellen told us a couple of years ago with the transitory inflation. Oh, we don't have to worry about this inflation. It's just transitory. And she knew better. She knew better, because there's no such thing as transitory inflation. There never has been. There never will be. You either have big time inflation or you don't. And that inflation ran wild, and she tried to pass some BS on us that it was like, oh, it's just going to be a passing thing. It's going to go away. Now they're trying to scare everybody with the tariff stuff. Oh, the tariffs are going to drive inflation. It's going to be horrible. This and like, no, it's not. It's not. It's not going to happen. And and like I said, and hey, bookmark it. We'll see by the end of the year. We'll see if I was right or see if I was wrong. I'm betting I'm right, but if I'm wrong, I'll be happy to eat the crow. I'll be happy to eat it. So happy to fall on my sword, so to speak. So, all right, man, a lot of crazy stuff. A lot of stuff happening in the banking world and the finance world. It just amazes me how first couple of weeks of this year have just been absolutely wild with the news. But like I said, it's great for me because it gives me a lot of stuff to talk to you guys about and share a lot of information with. So I thank everybody for being on and just hanging out with me on this Saturday night. I know there's a lot of other things you could be doing than listening to me talk about finance stuff, but I appreciate it. I love everybody out there. And like I said, I'll just say, hey, if you like the live stream, please make sure to like, share, and subscribe. That really helps the channel. I am trying to make a run up to 1,000 subscribers here on YouTube. So if you like what you're seeing, please spread the word. There's nothing better than organic growth. And let people know that, hey, there's this guy on YouTube. He's doing a good job, and hopefully tell him good things. I love it. And remember, we are on YouTube, Rumble, and all major podcast platforms. Remember, always leave your comments below because I love getting back to people, and make sure to check out some of the other content on the channel. But with that, I hope everybody has a wonderful weekend, and I'll be back at the same time, same bad channel next Saturday night. You'll be back in the strategy room with the banker next door. Thanks a lot, everybody. Enjoy the rest of the weekend. See ya.